Okay, so after the market's wild roller coaster ride lately, the big question on everyone's mind is this. Was that bounce just a dead cat bounce, or did we actually hit the real bottom? Today, we're going to dig into a technical playbook that can help us figure that out, giving us a clear system for navigating whatever comes next.
So let's just get right to it. We saw that huge, sharp drop, and then, a few days of a bounce. It feels a little better, sure, but is the danger really over? Are we actually out of the woods yet? That's what we need to figure out.
A quick price rebound can be so deceiving. Because price is really just the tip of the iceberg. It's like a rearview mirror. It only tells you where the market has been. To really understand the risk, we have to look under the hood at the market's true momentum, the real engine behind the move that gives us clues about where it might be going. So, first things first. Before we even dream of picking individual stocks, we've got to check the health of the overall market. Think of it like a doctor taking a patient's vitals. So what are the big warning signs flashing right now? The very first thing we're watching are these critical levels for the big indexes. You can see the NASDAQ is basically in a tug-of-war, caught between a ceiling at 22,809 and a floor down at 22,456. The S&P 500, same story, just different numbers, battling between 6716 and 6610. These are the lines in the sand where the buyers and sellers are really duking it out for control.
But here's the thing. Just looking at price is totally misleading. That recent drop dealt a really serious blow to the market's underlying momentum. I mean, its engine got seriously damaged. It's kind of like a runner who badly twisted their ankle. Yeah, they might be standing up, but they're not about to sprint a race. That's pretty much the state of the market right now.
And wow, this chart just shows that damage perfectly. Our momentum indicators for both the NASDAQ and the S&P 500 have absolutely plunged into their weakest zones. Look at those numbers. This isn't just a minor dip, folks. This is a significant loss of internal strength, and that kind of damage, well, it takes time to heal.
So, if the overall market is weak, what's the game plan? In an environment like this, you don't go looking for what's been beaten down the most. No, you go on a hunt for those rare pockets of exceptional strength.
And the tool we use for finding these outliers is called relative strength. It's really just about identifying the stocks that refuse to go down with the ship. They might bend a little during a correction, but they don't break. And because of that hidden strength, they are almost always the first ones to surge ahead when the market finally gets its act together. Let's look at a perfect real-world example. Taiwan Semiconductor, TSM. During that recent drop, the NASDAQ index broke clean below its key momentum line. But look at TSM. It held firm above its own, and check out the recovery. TSM has already clawed back over 50% of its drop, while the NASDAQ is still kind of struggling. That right there is a textbook picture of relative strength in action.
Okay, now let's add another layer to our analysis. It's time to become detectives and spot the footprints of the big money, the institutional players, to see where they might be quietly buying things up.
All right, here's a fascinating idea, and it's a little counterintuitive. Where we see panic and fear during a sharp market drop, the big institutions, they often see an opportunity. They can actually use the chaos of a sell-off to scoop up huge positions without anyone really noticing.
And there's a repeatable pattern to look for. Let's use Coinbase as our case study. So first, you get this sharp, scary price drop that just smashes through a support level everyone was watching. But then, right in the middle of all that panic, a technical signal for institutional accumulation pops up. Suddenly, the selling just dries up, the stock finds a floor, and it starts its next leg up. And this isn't just some theory. You can see it in the data. During that recent dip in Coinbase, the average cost basis for institutional money actually went up by about $3, from $3.32 to $3.35. Now, what does that tell you? It means they weren't selling with everyone else. No. They were buying aggressively as the price fell, pushing their own average costs higher. They were building their position in the weakness.
Okay, so now let's put all these pieces together, the market health, the relative strength, the institutional analysis, and apply them to one of the most watched, most debated stocks on the entire planet, Tesla.
Right now, Tesla is sitting at a really pivotal crossroads. The entire battle is being fought in this super narrow $10 range between $426 and $436. Seriously, what happens right here in this little zone is probably going to dictate the stock's next major move. So, what's the plan? This strategy is called Guard 2, Wait 1. It's simple and it's disciplined.
First, you guard the power indicator. We need to see that underlying buying strength turn up. Second, you guard the momentum. The stock has to bust through that resistance at 445. And finally, if and only if those two internal signals are a go, then we wait for the price to confirm it all. A solid break and hold above that crucial 436 level.
And this is absolutely crucial. A good plan has to account for both possibilities. This is not about predicting the future, it's about reacting to the present. If Tesla fails to break out above 436, the plan doesn't fail, it just shifts. We pivot and we wait patiently for a potential opportunity near the next big support zone around $400.
And that brings us to the final and, you know what, maybe the most important piece of this entire playbook, the mindset. The whole philosophy that ties all of these technical tools together. So, here are the key takeaways. Number 1, always have a plan before you even think about clicking that buy button. 2, manage your risk. Start small. 3, learn to use volatility as a friend. See those big swings as opportunities. 4, and this one is huge, think in if-then scenarios, not rigid predictions. And finally, focus on executing a solid process every single time. That's the only thing you can actually control, not the outcome of any one trade.
And really, that's what this all boils down to. This entire system, it isn't about having a crystal ball. It's about building a solid framework so you are ready for whatever the market decides to throw at you next. So I'll leave you with this question to think about. In your own approach, are you spending more time trying to predict the future, or are you preparing for it?